And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like or find this content interesting, hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might find this of interest, why don't you go ahead and hit the share button below and you can share it with them as well. So I stumbled upon the Humble Dollar. Okay, I guess it's an investment site, and there's an article by Adam Grossman called "Going to Extremes." I want to read a little bit from the article because it's another proof, let's say, why it probably doesn't pay to invest in individual stocks, individual securities, and you're far better off investing in indices. He starts stock market investing requires a near superhuman ability to withstand pain. That's the conclusion of a recent report by investment researcher Michael Mauboussin. He surveyed all stocks trading on U.S. exchanges over a 40-year period between 1985 and 2024. He found that the median stock experienced a decline of 85% at one point or another. Worse yet, more than half of these stocks never fully recouped their losses. The median stock recovered just 90% of its prior high water mark. Among those stocks that were able to reclaim their prior highs, it was a very long process, about 5 years on average. This would have tried any investor's patience, he says. Those numbers only apply to the median stock, but suppose you had above average stock picking stills. Okay, say you were an unbelievable stock picker. How would things have turned out? Well, if you had the foresight to pick the 20 best performing stocks over that 40-year period, they still would have delivered an agonizing drawdown of 72% on average, right? People don't remember this. It's hard to remember, he says. But Apple dropped 83% at one point. Nike once lost 66%. Even Nvidia, the market darling. And can I tell you, I've got clients calling me all the time, put more money into Nvidia, more money into Nvidia, right? It's been the best performing stock over the past 20 years through 2024, lost more than 90% at one point. And most notably, Amazon was once down 95% from its prior high. If you look past, this is my own thing, right? If you go, the high flying tech stocks of today, the ones that were around in 2000, 2001, right, when the high tech bubble burst, they all got crushed. They all lost between 70 and 90% of their value. A few of them, the ones like Microsoft, Apple, right, those we know about, those are still around, Cisco, Intel. But, a lot of them never came back. And the ones that did, it took years for them to get back to where they were trading, like in 1999 or at the beginning of 2000. In getting back to what he says, in general, the stock market is rational. Over the long term, share prices do move in tandem with corporate profits. When a company's earnings increase, often its share price does too. The problem is that prices are only sometimes rational. Very often, stock prices disconnect from corporate earnings, and the gap can be significant. This was first proven empirically in the 1970s by Israeli economist Daniel Kahneman and his longtime collaborator Amos Tversky. In 1974, we're going back 50 years plus, they published a paper titled Judgment Under Uncertainty, Heuristics and Biases. It was one of the first papers in the nascent field of behavioral finance, and what they found was that investors exhibit an availability heuristic. That is, they tend to rely on the information that is most available. That's a problem because the information that happens to be most available isn't necessarily the information that's the most accurate or even relevant. Often, the information that happens to come to mind, as Kahneman and Tversky put it, the information that's most vivid. In other words, extreme information or news becomes most memorable and thus drives decision making. Later research built on this. In the 80s, we had economists Richard Taylor, Werner DuBont. They titled a paper, Does the Stock Market Overreact? They found that share prices definitely do overreact. It's for some of these reasons, he says, that Warren Buffett scolded investors for their short-term thinking. During the market slump earlier this year, right? We're talking about 2025. Buffett commented, if it makes a difference to you whether your stocks are down 15% or not, you need to get somewhat different investment philosophy, adding that people have emotions, but you got to check them the door when you invest. On this point, Buffett's late partner, Charlie Munger, was more blunt. If you're not willing to react with equanimity to a market price decline of 50%, two or three times a century, you're not fit to be a common shareholder. Okay. What's this mean, right? You get the, and the problem is, right, even when the best stocks drop, well, should you buy them? Like, we don't know, right? We only know this is only like after, right? This is Money Morning Quarterback, right? You know that Nvidia recovered. You know that Apple recovered, right? What about iBasis? Remember that? Marvel Communications. Those are two of my favorites back from the giddy up, rah rah days of the pre high tech bubble. Can't tell you how much money I lost in some of those names. IBAS, MRVC. Yeah, one of those is still, both of those stocks are still a joke for some of my friends. MRVC, I've got a friend who says, "Oh, hey, how are those January 55 2021 calls doing on MRVC? We thought we were going to become mega millionaires on those, but they blew up." And no, but those two companies are in the dustbin of history. Okay, it just, if you invested in Microsoft or Priceline or whatever, you did great. If you invested in iBasis or Marvel Communications, Webvan, all those companies, right? Remember those names? You didn't do so good. But what would be a good way to alleviate that? Well, if you invest in indexes, you're sort of always, by definition, getting the best companies at that time, right? Because especially market weighted indices, because the cream rises to the top. The best companies become the more dominant, highest weighted companies in that particular index. Whereas, like today, the S&P 500, you've got Meta, Facebook, you've got Amazon, Google, Microsoft, Nvidia, right? These are the the biggest high tech companies in the world, and they're going gangbusters, right? They're printing money, their outlooks are unbelievable, and they're a huge chunk of even the S&P 500 index. And you know what happens if they were to drop down and not do so well? They'd be a less percentage, a less, they'd have less exposure, less influence on the index, and some new company that we don't even know about will take their place. That's always happens, right? These companies rotate in and out of the top spots of the indices all the time. Remember, whatever GE and Exxon were used to be the biggest positions on the S&P 500. Where are they today? Right? So if you don't want to have to worry and understand, obviously, if you're investing in the stock market, you have to understand markets drop. Like Charlie Munger said, right? If you don't expect a market price decline of 50% a couple of times a century, you're in the wrong business. So that's going to happen. But individual stocks are much more volatile, right? We can see 50% drops in individual stocks much more frequently than a couple times a century. You can see it happen a couple times every couple of years. That can happen, even the best companies. Do you buy them when they drop or do you not? Well, I don't know. Sometimes yes, sometimes no. Maybe it'll be the next Microsoft. Maybe it'll be the next IBAS. We just don't know. But if you're investing in the index, you might not hit that grand slam, but you're going to sure do awfully well over time, right? Past performance is no indication of future returns, but historically, indices, S&P 500, whatever it might be, your NASDAQ, whatever, have done incredibly well. And you don't have to have your finger on the pulse, and you don't have to make those agonizing decisions. When do I sell? When do I buy? Because it's really, really hard. And even if you buy and things drop and drop and drop and drop, it can take 5 years, we saw, right? Then things can come right back and vault forward. But you don't know when that's going to happen. You know if that's going to happen. But if you want to protect and grow your money for the long term, maybe you should give up on the individual stocks and stick to indices. It's a much better approach. Again, just more and more and more statistics that sort of go and prove that. Right? What did we say at the beginning? The overwhelming majority of the stocks never came back to where they were, to their high water mark. 85%. I mean, that's crazy. The median stock recovered to just 90% of its prior high water mark. I mean, you're chasing dreams oftentimes if you're buying individual shares. You're much better off in indices. Okay? You've been tuning in to the Aaron Katzman Show. We speak about your life, your money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might find this of interest, why don't you go ahead and share it with them as well. Thanks so much for tuning in, and we'll speak to you soon.